Okay, we've got a little past top of the hour here in San Diego. I want to start with a very sincere thank you to everybody for joining us this evening, again, or this morning, depending upon where you are. I'm Bob Schmidt, Executive Director of the Brandis Center at UC San Diego's Rady School of Management. I'll be your moderator for today's discussion. We've got two exceptional panelists joining us today to talk about U.S.-China relations and investment opportunities. I will introduce them both in a moment. Before I do that, I want to thank Assistant Dean Wendy Hunter-Barker for your work in preparing today's event, and also the IT team at Rady, especially Chris Blanchard. We couldn't host these webinars without you. Also, thank you to Charles and Renee Brandis. It's their generosity and vision that makes the Brandis Center, our research, and these types of events possible. Now, just to set the table, we've got an hour for our agenda, and honestly, we probably could talk for 100 hours given the topic, but we'll look to keep our comments focused. Our panelists will share their insights for about 10 minutes each to start. They'll address what they see as the key points from the perspective of macroeconomics, policy, and investment opportunities. After each concludes, we'll open the floor to questions, so feel free to click that Q&A icon at any point to share a question, and we'll try to hit as many as we can. I'll also share some questions we got from participants as they registered. We got a number of really good questions already, so we've got them queued up and ready to go. Now, full disclosure, we are recording today's event. We'll share that recording with each person who registered, and we'll try to get that out to you in the next week or two. Last point before I introduce our panelists, we'll likely cover a lot of ground today, including a discussion of investment opportunities. We are not making any specific investment recommendations. Before you invest, before you act on anything you hear today, we encourage you to first talk with a consultant and/or financial advisor. So, having shared all that, I want to welcome our panelists, Dr. Victor Shih and Louis Lau. Victor is the director of UC San Diego's 21st Century China Center, an associate professor and Ho Mu Lum Chair in China and Pacific Relations at the School of Global Policy and Strategy. He's an expert on Chinese banking, fiscal policies, exchange rate, as well as the country's politics. He's the author of 2 books and dozens of published articles on these topics and more. Prior to joining UC San Diego, Dr. Shih was a professor of political science at Northwestern University and principal for the Carlyle Group. Louis Lau is a chartered financial analyst and director of the investments group at San Diego-based Brandis Investment Partners. He is a partner of the firm's parent company, senior analyst on the financial institutions team, and member of the Emerging Markets Investment Committee. Before joining the firm, Louis was an analyst at Goldman Sachs. He earned his BBA in finance with merit from the National University of Singapore and his MBA in finance and accounting with honors from the Wharton School. Louis has more than 25 years of investment experience. So, gentlemen, again, thank you so much for joining us. Now, Victor, I'll turn things over to you.
First of all, thank you, Robert, and also Wendy for organizing this. It's very exciting for me to speak to the business school. I think it's the first time I have done that at the UCSD Business School. So thank you for giving me this opportunity. Today, I'm just going to first show a few slides, and then, of course, I would love to get into a conversation with you and Louis, sort of about the state of China's economy. So, as most of you know, the Chinese equity market has underperformed the US equity market for quite some time now, which is a little bit surprising if you think about it, because, of course, China was the first country to successfully control the spread of COVID in 2020. Manufacturing and the economy very quickly recovered as the rest of the world, sort of especially the United States, continued to struggle with COVID outbreaks, lockdowns, etc. So for a little while in 2020, the Chinese stock market did outperform the S&P, but that very quickly went away with the unfurling of our stimulus program, in the middle of 2020. And since then, we've seen more or less very consistent outperformance in the US. So the question is, why is that the case? I mean, from a kind of a medium-term perspective, this also is a little bit weird because China is still a developing country, so naturally its growth rate should be higher than that of an advanced country like the United States. And as a result, you should see this kind of outperformance in the equity market. Also, this is something that we have seen. Well, I don't know if India has outperformed China or the US, but it certainly has outperformed China. So that is the kind of performance that you would expect from a developing country. So one potential answer, and there are probably many different answers to this puzzle, but one of the answers is that the Chinese economy is faced with a lot of debt. And the debt, actually, typically when we think of debt, especially corporate debt, governmental debt, it would have an impact on corporate investment and maybe sort of corporate cash flows. But in addition to, and that certainly is happening in China, as I'll get into a little bit. But in addition, the other factor in China is that in the majority of the medium-sized and small cities in China, the so-called middle class, or even many people in the upper middle class, are in fact government workers. And so if there's high amounts of local debt that is curtailing expenditure at the governmental level, that is going to constrain middle class expenditure in many of these medium and small size cities in China. So I think and at the same time, of course, whereas the US had these wave after wave of massive stimulus, of course, that had its own downside, causing inflation, et cetera, high wages and, extraordinarily low unemployment, et cetera. In China, there was absolutely no demand side stimulus. There was a lot of supply side subsidies, which has helped the industrial sector to recover and has helped Chinese export to ramp up very quickly in 2020 and 2021. But there was hardly any demand side help. And so the combination of this high debt and this complete lack of demand side stimulus from the central government has led to persistent weakness on the consumer side. And then on top of that, of course, you have this kind of real estate leveraging crackdown, which has led to financial stress in the property sector, affecting the financial sector. These different factors, and of course, that, as I'll show, also bleeds into the problem of local government debt, right? Because a major way through which local governments obtain revenue is by selling land. But if property developers can't sell their properties, they're not going to acquire land. That will constrain local government budgets even more so, on top of this huge amount of debt and debt servicing that they've had to deal with on a daily basis. So really, there's a persistent downward pressure on consumption in China. And I think that is one of the reasons why stocks have underperformed in China relative to the US. So let me go through a couple of slides. So first of all, this is local government debt. So the local government debt in China, for most of you probably don't know the composition of this, I would break it into two different parts. One part is official local government debt, and there's an issuance quota which has to be approved by the central government. They started this program on a very massive scale in 2015, and as I'll show shortly, that scale has really ramped up in very short order. The other kind of local government debt is issued by these corporate entities that are majority state-owned by the thousands of local governments around China. So we're talking about provincial governments, obviously, but also city-level governments and even county-level governments have their own corporations. And the idea is that they would set up these shell companies inject into the shell companies some collateral, primarily land, because that's the main assets of local governments in China. And with the land collateral, these local government financing vehicles, or LGFVs, would go to a bank to borrow money. Or using the collateral, they would issue a bond with the collateral and to raise money from the financial market. The buyers of these bonds also happen to be the state-owned banks of China. So ultimately, so one question is like, who's holding the bag, so to speak? And it's primarily the state-owned commercial banks in China. But as you can see, as a share of GDP, even if you look at a pretty narrow time window from 2019 to the end of 2022, local debt as a share of GDP in China, which is a red line, has gone up from just a little bit, well, so let's say 35% of GDP to 45% of GDP, close to 45% of GDP in the space of 4 years, or really, yeah, 4 years. Whereas if you look at the equivalent statistics for Germany and the US, has basically stayed the same or declined even a little bit in the case of the US. Of course, federal debt in the US has gone up quite a bit. But in the case of China, the growth rate also is quite fast, compare. So here you see this more clearly. So this is the outstanding amount of local debt. The total is the blue line on top. So if you look at the time span between 2010 and 2023, which is the peak of this graph, has gone from basically zero to 55 trillion renminbi, yeah, which is like 45% of GDP in China, as I pointed out. The reason why it declines afterward is because we don't know what bonds will be issued after the current period, right? So this data comes from, we scrape the official Chinese website for bond issuance. So that we have the universe of all the bonds that have been issued in China for the past sort of 15 years. And basically, so even if you assume that no new bonds will be issued after June of 2023, which is when we stop scraping, local debt doesn't go away overnight, because it matures sort of in a staggered manner over time. This is why they recommend you to enter into a bond ladder, or whatever you guys call it when you're investing in fixed income. So it doesn't go away overnight. And as you can see, even if the Chinese government were to stop issuing bond, suddenly, it would still take years and years and years to digest this debt. Again, the debt is decomposed between the black line, which is the official local government debt approved by the central government, as well as the red line, which are these LGFV debt. The idea in 2015 was that the Chinese government wanted to stop the issuance of LGFV debt altogether, but as you can see, they were not successful in doing that, and we can get into why that's the case. And LGFV debt continued to be issued, and it's still sort of 20 trillion renminbi. So the problem with this amount of debt is that you have to service the interest and the repayments. So there's repayment that's happening constantly, and the repayment now is actually greater than, so for every month, the debt repayment, which is the sum of interest payments and also debt maturities, is greater than local government revenue altogether. So this is a problem. I mean, of course, it doesn't mean that all the local governments will go bankrupt, because you have central transfer payment, and more importantly, you have new issuance of debt to replace the debt that are maturing. But then this is just kind of Ponzi financing. And, what we show is that, to some extent, especially in certain particular provinces in China, you're definitely in the territory of Ponzi financing, where even servicing the interest payment requires the issuance of new debt. And that will, again, crimp on local government expenditure, which ultimately will, bring downward pressure on consumption. And of course, the other dynamic is that housing sales remain pretty weak. Look like it might have recovered in the beginning of this year, but then, after horrendous downturn in 2022, never seen since the reform period, but in fact is dipped sort of slightly below zero yet again in the June and July data. So that's not very encouraging. As a result, land sales, which is another source of revenue for the local government, continues to be close to negative 20% after basically the whole year of being negative 20%. So compared to 2019, land sales revenue, is like whatever it is, close to negative 40, negative 50%. And that also is putting a lot of downward budgetary pressure on local governments and also downward pressure on local economic growth, because this virtuous cycle of selling land to finance infrastructure had been the source of growth for a lot of the medium and small cities in China, and now that has basically evaporated overnight, and it's not having any signs of coming back so far. And this is putting a lot of downward pressure on the Chinese economy. So is there a way out? So I think most of the experts that I've talked to, both in the US, not so much in China, although increasingly even in China, some people are starting to say it, is that the one balance sheets that remain pretty healthy in China is the central government balance sheets. So some people are calling for a US style stimulus, which is primarily or purely demand side, where the central government would issue a lot of debt and then either directly transfer income to households or tremendously boost some of the social welfare expenses of households, like medical care, like education. So one little known fact about China, high school, so senior high school is not free in China. So the first grade school and junior high is free in China, but not senior high school necessarily. I mean, it's free for some people. Make that free, boost there is some sort of basic level health insurance in China, but certainly it can be tremendously boosted, especially for the poor, for the elderlies. Do things like that, and that's in ways force expenditure that will free up cash in the household budget to consume, for them to consume, and that can potentially lead to a great recovery of the Chinese economy. Right now, we don't see any of it. There's easing of housing policies, but as you can see, it doesn't seem like these policies are working. So hopefully the Chinese government will figure out a way out of these various issues. Anyway, at this point, I think my time is up. I'll pass it over to Louis here. Let me stop sharing here.
Yeah, Victor, I just want to thank you so much. I just want to jump in because I've got a couple questions, but we'll circle back to those. If y'all have questions in the field, please click on that Q&A icon and type them in, and we'll do our best to get to them. So I'm going to bow out now. Louis, I know you've got some slides to share. I'll pass the floor to you, my friend.
Okay, great. Thanks, Bob, and thanks, Victor. And hopefully you guys are seeing this okay. Victor did a great job kind of listing out some of the challenges that China is facing from an internal point of view. My segment is going to focus more on some of the external pressures on China's economy, and particularly, in a phrase that we dub, globalization 2.0, which is really kind of a reversal of the trend that we've seen in the last 15 to 20 years, ever since some of the previous Chinese leaders opened up the economy to the world. China joining the WTO in 2001, that led to a long period of manufacturing market share gained by China, where their market share went essentially from 10%, 20 years ago to 30% today. And so today, China is a manufacturing juggernaut on the world stage with 30% of 30% of market share of manufacturing in the world, and has a lot of vested interest in kind of keeping the trade relationships with the world open, as well as maintaining their edge in global manufacturing. But a profound shift has actually happened, and let me just show you what that is resulting in. So on this slide, you can look at the change in the total imports from the U.S. By the U.S. from China over the last 5 years. And one of the important shifts that has happened is that China has actually lost market share of U.S. imports, right? So if you look at the last 5 years, the market share of U.S. imports from China has dropped by 5%. And meanwhile, where has that 5% gone to? Is gone to countries like Vietnam, Taiwan, Korea, Thailand, and I'll particularly point out Mexico as kind of the largest market share gainer among non-Asian countries, right? So an important shift has taken place in China's history of manufacturing. And this is caused by both internal and external reasons. So the internal reason is ever since COVID broke out, after the initial period in 2020 and 2021, where China had a lot of success in keeping the manufacturing supply chains open, getting people back to work, controlling COVID, that then came with kind of an overzealous control, if you will, over people movements in 2022, and that made China a less reliable partner for global manufacturing, right? So a lot of companies began implementing what is called the China plus one or China plus two strategy, where they are looking to complement China with another country, which is sort of less risky from a reliability point of view, both in terms of keeping the supply chain open through COVID, as well as the impacts of tariffs. And one of the things that I will show, which is very important, is that the US actually has a very major part to play in this shift in market share. And this really started in 2017 with the Section 301 investigations, which is really finding a reason for implementing tariffs on China by identifying unfair trade practices. So till today, there is an average 19% tariff being implemented on US imports from China. So the US companies and the consumer are actually paying an average of 19% to the US government to import goods from China. So there's a big incentive for Chinese companies as well as foreign companies to shift production to other places like Southeast Asia, to India, to Mexico, simply to avoid this 19% average tariff, right? So that's one. At the same time, in 2022, there was a lot of legislation that was passed to bring semiconductor manufacturing, as well as through the Inflation Reduction Act, increase the domestic content of renewable manufacturing, solar energy, batteries, and then the $7,500 credit for electric vehicles that actually need to qualify for this credit by increasing their North American sourcing of minerals and batteries from 50% to closer to 90% over the next 5 years, right? So, the US had a very important part to play. And so we see that as a source of external pressure on China. One of the things that I'll touch upon would be the change in the geopolitical landscape. This is kind of a map that, we laid out showing that the US and its friends, make up almost 60% of the world GDP, whereas China and the countries that are friendly to China is slightly north of 20%. And so in this world that we live in, we're kind of moving from, free trade, an even playing field, if you will, among countries in terms of, who to buy goods and sell goods to and trade with, to a world that's a little bit more polarized in terms of the security of the supply chains, right? And there's a group of unaligned countries such as Latin America, Africa, Southeast Asia, that both sides are trying to get leverage in terms of getting a closer relationship. Some of these countries don't really want to take sides, and that has very important implications for investing as well, in terms of which geographies to pick, where to invest, which we'll go into a little bit more. Just wanted to maybe spend a little bit of time on the property market, kind of extending from Victor's discussion. So we don't have a specific slide on this, but just a general comment is that property and related industries, including infrastructure, property services, currently make up about 30% of China's GDP. And if you look at South Korea and Japan, similar Asian countries at the peak, these kind of real estate related industries made up about 22% at the peak of Japan and South Korea's GDP. And if you look at the US GDP today, around 13% of US GDP is made up of real estate and similar kinds of industries. And so it's a long way to go from 30% of GDP in China tied to real estate down to the 20s or even in the teens, right? So I think our view on the property market is a long-term deflationary trend. And if you look at the last 5 years, or in particular intensified in the last 2 to 3 years, regulation in China has been tightening leverage on developers, right? And so there has been a conscious effort by the Chinese government to move away from property investment as a very important driver of the economy and shift it to newer growth areas like electric vehicles, batteries, renewables, things like that, which and that new economy part of the new economy industries make up only about 15% of the economy right now. So it takes time to pass the baton from real estate to other parts of the economy. And so China's economy is slowing down because of this transition. Lastly, we want to cover what are some of the investment implications when we think about China in the context of globalization 2.0, which is we need to start thinking about some of these forces at work when we look at individual companies. It's not just, if you look at the history of how the company has done and trying to think about when things normalize, how does it, can it go back to how it performed historically? But we have to think about, perhaps some of these forces have changed, affecting, domestic companies, exporters. And so we need to think about the big picture and factor in some of those risks and opportunities. Thinking about how can we handicap geopolitical risk premiums. For some of the smaller countries in Southeast Asia or Africa, they're probably beneficiaries of trying to benefit from both sides, investment from China as well as security guarantees from the US. So those will likely have lower geopolitical risks, if you will. And so kind of thinking about differentiating geographies in this context. And then, there's also a lot to be said about risk management, kind of avoiding potential landmines. One area would be Chinese technology companies that are involved in surveillance, violation of human rights, or technology companies that are likely to be sanctioned by the US government. And so these could be areas that you might want to stay away from because there's risk that the investor base could be shrunk purposefully by the US government or European governments who don't want to direct capital into those areas. And so at Brandis, we believe that value investment or the value investing philosophy doesn't change, but we do need to, in the application of these value investment principles, we need to take into account some of these big forces as the world evolves. And so with that, I'm going to stop my portion and hand it back to Bob.
Okay, Louis, terrific. Thank you. And thank you, Victor. We got a couple of questions that have already tumbled in the Q&A. Victor, I'll turn these maybe over to you to start, because from what I heard, given this debt overhang in China, maybe it's lower for longer in terms of GDP growth. Right here in the States, we're dealing with higher for longer, potentially with interest rates. If that's true, kind of ties to these questions that we got. One from maybe it's Abdrew or Andrew. If the Chinese government gives cash to people, will they just save it? So that's more, I think, on the stimulus side. But maybe start with Hanbo's question first about what's the source of revenue for paying down some of that debt?
Yeah. So again, the the central government balance sheets continue to be relatively healthy at with debt, sort of only 30% of GDP compared to 100+ % here, and in most of the developed world. So I think they can certainly leverage that up. In the government policy-making circle, what I think is happening is that for the first time in recent memory, the Chinese leadership actually has some kind of budget constraint, right? So, they would like to do a lot of different things. Obviously, for Xi Jinping, as Louis alluded to, this competition with the United States is a very high priority, and that involves billions and billions in subsidies in all kinds of technology sectors, as well as a very robust national defense expenditure every year. So if they were to massively leverage up the central government balance sheets, they can do that. That personally is one of my recommendations, is to basically a lot of the basic public services that currently are paid for by local governments with very uneven delivery, just because some localities like Shanghai have a lot of money. They can provide world-class medical care and education, etc. Other places are very cash-strapped, especially right now, so they're a lot less able to do it. Maybe except for Shanghai and a handful of wealthy places, the central government can just underwrite the expenses for a lot of these social services. But if that were the case, then their ability to plow money into, chips, subsidies, and defense, et cetera, might be curtailed. And that's not a desirable state of affairs for the top leadership. So for them, that's why I think they would prefer to say, oh, well, pretend that local governments have resources with which to pay for all these different things and just issue an order to the local level and say, okay, you guys pay for universal education, K through 12. But local authorities, they don't have the money to do so. So they have to either borrow more money or pretend that they're providing a service when they're not actually providing it. This basically saves the central budget for some of these higher priority things like national defense and technology, etc. But the result of that, so that's basically what the Chinese government has been doing, but the result of that is local debt continues this very high pace of growth, which I think eventually will reach very alarming levels. Right now you can say, well, it's not so alarming at this point. And also, by the way, one thing I neglected to mention is that the data I have does not include the bank loans of LGFV, which by various calculation is between 30 to 45% of GDP. So if you tag on that to my 45% of GDP, local debt is, sort of like 80 to 90% of GDP, plus 30% central debt. You have government debt of like 120% of GDP. So it's already not ideal. But the Chinese government doesn't want to waste the central balance sheet on social welfare. I'm not worried that people are not going to spend the money, because the below median households in China, they have very little savings. So if you give them money, they will spend it. They'll have to spend it. If you're afraid of that, then give them services like medical care, like education. That's, in a way, it's like forced spending. That will free up their budget in other areas and allows them to spend more.
Yeah, but it correct me if I'm wrong. It sounds like the Chinese government has not been in this position for a long time. They really have to make some hard decisions about where the money is going to be spent.
Yeah, they haven't been in that position in a long time. There were the best years were sort of between 2000 and 2015. China joined WTO, massive kind of current account surplus. Today is still pretty substantial, but back then massive, huge amount of inflows, which means the foreign exchange reserve was growing like crazy. At the same time, because of high economic growth from net export, basically government revenue also filled up, would increase by 20-30% a year. So there was absolutely no issues there at that time. They could do all kinds of different things at the same time, but not so much these days.
Thanks, Victor. And Louis, you had mentioned in one of the slides that touched on the exports from China decreasing to the United States and some of the other countries being beneficiaries of that, including Vietnam. We had a question from one of the registrants prior to the event, I think from Richard, who said he's more interested in India and Vietnam. Can you talk about maybe investment opportunities in either of those countries as a result of greater trade with the U.S.?
Yeah, sure. So in India, directly investing in manufacturing in India is quite difficult because a lot of these companies, for example, Honhai or Foxconn, they're actually foreign companies. Their investment in India is going to be part of a very big company. So we think that direct exposure to that theme could come from investing in some of the Indian corporate banks that lend to some of these companies that are expanding. So basically, as companies deploy capex into India, as well as some of the Indian conglomerates and families, they'll need to finance it with a mix of equity and debt. And some of the debt is going to manifest itself in terms of a new corporate loan growth cycle in India. So that could be a way. There's actually also dedicated infrastructure and construction companies in India that you can also invest in, because we all know that there's a huge infrastructure deficit in India, and the infrastructure in India is very much poorer compared to China. So that's another thing that you can also look at. And then in Vietnam, there's also kind of basic materials and commodity companies like steel companies that are involved in construction. The banks, a little bit more complicated in Vietnam, just because there's no one clear bank that I think has a good kind of clean, exposure. A lot of them are state-owned, and there's maybe governance issues. So I'd probably look at some of the basic materials companies in Vietnam that are tied to infrastructure in those markets.
Okay, thank you. And one more for Vic, or for Louis. You had touched on this earlier about some of these macroeconomic policy issues affecting your thinking, and you've got to account for this when you're investing. We got a question from Sube before we started about how do you think about fundamental investing in China? And to me, that's a balancing act, perhaps, between the fundamentals for a company that may or may not be attractive, and you put those on a scale, I'm guessing, with some of these macro issues. Can you talk about how to think about those things and maybe some investment opportunities around them, please?
Yeah, this is a very bad analogy, but it's kind of like maybe you're walking on a tightrope and trying to juggle at the same time. So there's a lot of different considerations that you have to balance. And maybe just to kind of raise a couple of more concrete examples is, we have to think about China China investing in a multifaceted fashion, right? So at one end is China regulatory risk on its own companies. On another end is the pressure coming from foreign sanctions. And then you have to look at the bottom-up capability of the company as well. So just to kind of boil down to specific examples, in terms of industries, we all know that the EU is raising a lot of noise about electric vehicle exports from China to the European Union. Some of the domestic manufacturers like BMW, Mercedes-Benz, Volkswagen, I mean, they're now playing catch-up from the transition of internal combustion engine to EVs, while China is already in a totally different level, much higher level in EVs, right? And a lot of the Chinese EV companies, the valuations aren't that attractive. And so there's a risk that, they won't be able to expand in Europe. There's curtailment, in the US as well, because, the US wants to help its own EV companies. So that's an industry that may be a little bit more troubled. And again, not in terms of exports, and then not cheap. But some of the maybe simpler products like home appliances, they're probably not going to, it's not a strategic product, right? So the West is not going to put sanctions on those. And meanwhile, there's a huge need for air conditioning in Latin America, in Southeast Asia. So that's a lot more straightforward to invest in terms of home appliances. And then solar panels and renewables, right? So the US and Europe are very far behind. And if they want to reach their climate goals, they have to import some of those products from China and Korea, solar panels, batteries, and things like that. And so when we think about investments in China, we're also factoring in the geopolitical as well as the macro angle.
Yeah, I would jump in very quickly on this point. So there's a lot of talk say, oh, China is not investable and all this kind of stuff. In the aftermath of what happened to Ant Finance and so on and so forth. I would say that's not true. Despite everything, unless you assume like these very black swan scenarios, like war, or, some crazy thing like that. It really depends on the sector, right? So real estate is a dirty, dirty business in China. Inherently, think about it. It involves the transfer of land, which belongs to the government, into private hands. And then just during the process of this transfer, the land will gain value tremendously because the land gets reclassified from farmland or industrial land in most cases into residential land. And so enormous amount of rent is being created. Who gets a hold of this rent depends on, greasing the palm and so on and so forth. So in China's very dirty business, the people who are very successful in doing that, like Yin, who's just was arrested a couple weeks ago, engage in all kinds of shady practices. And so I would say real estate has always been a kind of a risky, proposition in China. It's just that many of the risks began to manifest, more recently. I completely agree with Louis that manufacturing is almost completely different. I mean, there are regulatory risks both in China and also abroad from protectionism. But if a bottom-up analysis and the data tells you that this is a high-quality company producing goods that have global appeal, you can invest in it. You may not always pull the trigger, and timing, all these factors still matter, but I don't agree that manufacturing in China is uninvestable.
Okay. Victor, that's great. Can you comment a little bit about the real estate market? I know Country Garden, or what's the other one? Evergrande, kind of in the news of late.
Yeah, I mean, my quick commentary is that, I've been looking at Evergrande for, 10 years. And they have always been levered up to the tilt. I mean, it's crazy the kind of stuff that they used to do. Basically, as you know, in China, there's this practice of pre-sale, which is you start selling apartments before the building is even built. So what they would do is to buy a piece of land, start pre-selling immediately, take the proceeds of pre-sales, which you're supposed to use to build a building, but they use that money to buy even more land. And then more land and more land, and then use whatever residual money they have after buying land to slowly build up these buildings. They managed to make it work. They had projects in hundreds of cities across China. Who knows what dealings they had with local officials, the bankers, and so on and so forth. Incredibly dirty, and so there was a group of guys on Wall Street that was shorting Evergrande for 10 years, and of course, it's like the Widowmaker trade. A lot of trades blew up as a result because they kept on surviving the craziest level of leveraging and the shadiest stories that would circulate about Yin, the founder, and other corporate executives. They survived it all until this year. Then they got a massive amount of trouble, and then all of a sudden the whole company blew up. So yeah, so things like that is not, for the faint of heart. But it's a very different story with manufacturing companies with proven export markets. They're selling billions and billions of dollars. I mean, the only exception I would say is like when you see a company that starts doing stuff that's very far away from their core competence, then that could be alarming. By the way, Evergrande started its own EV company, but it turned out this was all ruse to borrow more money from the bank, and ultimately, the company still blew up despite everything.
Well, it's the classic investment mantra, right? It works right up until it doesn't, and you just don't know when that's going to occur. Louis, I want to go back to you because I think I'm trying to listen and take some notes. I think you said on the manufacturing side, kind of green technology, maybe solar panels or electric vehicles. Those are some good opportunities? Any others that you see? And maybe trying to tie in a question from Q&A here from Terry. Are the investment opportunities going forward more likely to lie outside of China with companies that have some exposure to China, or is it directly investing in China? I don't know if you can tie those two things together.
Yeah, sure. So one of the areas that we're still positive on is the resumption of domestic travel. So if you look at the latest Golden Week figures, the travel and as associated revenues have already gone up to 110% of 2019 levels. So domestic travel still continues to be very strong. And then within that, Macau is actually recovering very strongly. So there is a perception that the Chinese people have no money to spend because the 3 years of COVID just impoverished them. But one of the interesting data points is if you go and look at bank deposits as a percentage of GDP or bank deposits, the absolute level of bank deposits is at actually an all-time high, and a lot of those bank deposits are because there are no good investment opportunities, I guess, for the retail investor in China, or at least that's kind of the fear, a lack of confidence in the economy. And also a lot of high or medium income households choosing to save and pay down their mortgages rather than spend. So there is actually a lot of savings lying within China. And if you look at some of the, I would say, more reasonably priced goods, they're actually performing quite well. Restaurants, casino, gaming, I mean, all that is performing quite well. So that's another area that we think continues to recover. And then on that second question about investments outside of China but are tied to China, I think that the theme here is that increasingly the market has been focusing on companies that may be domiciled in the US or Europe or even Taiwan that have some exposure to China but are not domiciled in China. So this gets around the question of, okay, what if Chinese equities are sanctioned, right? So then this is a way of investing in the China recovery story, but then you don't have to take exposure in domestic Chinese companies, right? So it could be a European luxury goods company that has 30 to 40% of sales from China. It could be a bank in the UK or Singapore that has banking franchises within China or Hong Kong. So those would all be good examples of trying to get China exposure without going through domestic Chinese companies.
Yeah, and earlier, Louis, I think you'd mentioned just be wary of companies that may be targeted by the U.S. Surveillance, I think, was one term that you used. But maybe I'll start with Victor on U.S.-China relations. What do you see going forward? Because a part of me thinks, okay, if the U.S. is really going to crack down on not just surveillance, but overall, where do you invest? So kind of taking a step above that, where do you see U.S.-China relations going forward?
Yeah, I mean, especially as we enter election seasons, I think a lot of pretty extreme policies might be proposed by Congress and maybe by presidential candidates. What policies actually get implemented, hopefully we've seen the worst of it, and we're not going to see that many other new things. But there could be some new things, sanctions against various Chinese companies, higher sort of fencing, so to speak, against exporting technologies to for example, Chinese biotech firms. That could be potential next set of targets. But otherwise, I think the weight of the ongoing trade is just so tremendous, right? So not only direct trade with China, which has gone down a little bit, but still is worth hundreds of billions of dollars. But of course, a lot of the components that are purchased by U.S. companies that come from China or indirectly from China, right? So a lot of goods or components maybe from Vietnam, but the Vietnamese factories are sourcing some of their components from China. And so China continues to be a very important part of the global value chain, and that cannot be changed in the medium term. And so as long as the relationship between the two countries do not become extremely bad, to a point of, nearly or, fighting some kind of kinetic war, I think there will still be a lot of trade between the two countries. Look at the late Trump years. I mean, it was quite bad. Of course, 2019, especially 2020. Nonetheless, because China occupies such an important place in the global value chain, U.S. import from China actually grew in 2020, as we struggle to fill our demand for medical supplies and PPE. So I'm not so pessimistic about bilateral relationship, even though we will see some very hyperbolic sort of language in the run up to the election.
Yeah, that's an interesting point, because it strikes me that, yeah, we in the U.S. have to talk tough on China. At the same time, we realize China is still such a huge trading partner, as you alluded to, even though it's less so versus a few years ago.
Maybe let me jump in here a little bit and say that it's actually pretty interesting. If you look at the 2023 first 6 months data, U.S. imports from China, it actually went down by 25%, which is the first year the imports went down dramatically. But one of the interesting things is that Chinese companies are increasingly moving their manufacturing to Vietnam, Southeast Asia, and Mexico. So those Chinese companies that are exporting from these regions are not captured in that data. So that could explain why optically it seems to be going down. But when we look at, when we analyze companies, we actually chanced upon the data that showed 42% of companies that have moved to Mexico are actually Chinese companies. And the next biggest group is US companies, with about 20% of the, the new investment in Mexico comes from US companies. And so I think one has, when looking at the data, one has to be very careful, because it could also be that the Chinese companies are moving production offshore, and this doesn't get captured as direct Chinese imports.
Yeah, that's a great point. Great point, Louis. I want to swing back to Q&A. Got another question from Hanbo about A shares versus H shares or others. Any comments on that from either of you?
Yeah, I think that we're taking a more diversified approach. We don't really pick one market over the other, because we believe that both markets have different opportunity sets. So the A share opportunity set, doesn't really have a lot of internet companies. So you got to go to the H share market or the ADR market if you want exposure to specific industries like internet. But on the other hand, A share companies are home to some of the most competitive manufacturing companies that China has to offer, right? Whether it's home appliances, whether it's solar panels, renewables, things like that. And so every market has a different opportunity set. I would say on average, the A shares are more expensive in terms of valuation, because it's a captive market only for Chinese capital. And since that capital can't flow out, usually the A share companies are more expensive than the equivalent H share companies. But again, we don't try to take sides. We look at all opportunities.
Thanks, Louis. Hey, coming up on the top of the hour, we've got maybe 5-6 minutes ago, we got a question in the Q&A about Taiwan. You guys want to tackle this one? I know this is a potentially really thorny topic.
Well, I guess I'll start with the geopolitical calculation. I mean, so my analysis is that there's no reason to believe that an invasion of Taiwan is inevitable. I just don't think that is the case. I mean, there's a narrative, even in China, people are like, oh my God, it's definitely going to happen, because the top leadership really wants it, whatever. The reality is we don't know. But what we do know is that Xi Jinping, maybe he does want to, invade Taiwan and unify China, but he doesn't want it so badly that he would invade willy-nilly. Because remember, he has been in power for 10 years already. If he was such a reckless person, he would have invaded already. So this is like kind of Bayesian knowledge, which is like the fact that he hasn't done it already means that he's making a very careful calculus as to the potential risk of doing so. And that, of course, if the stars align in China's favor, you know, the US makes a strong declaration of never intervening in whatever happens on the Taiwan Straits, let's say, you know, as unlikely as that is, and, you know, and the PLA tells Xi Jinping that they're, you know, 100% confident that they will be victorious in a very short order, maybe he would order an invasion. But short of those perfect conditions, I still think ultimately he is a very careful decision maker, as we've seen, you know, and he doesn't make decisions very rashly as far as we can tell. So I don't think, you know, all this narrative is like, oh, you know, it's not a question of if, it's a question of when. I just don't agree with that analysis.
Yeah. And who knows, right? But perhaps the situation in Ukraine is a bit of a, or maybe more than a bit of a deterrent. Who knows?
Right.
Yeah, I'd say you know, an invasion of Taiwan carries huge risk to Xi, you know, and his legacy if it were to fail. So I think he would only do it if you know, it was easy and it was a quick victory. But you know, I think the U.S. and others are probably determined to prevent that, because there are other security ramifications if, you know, Taiwan falls into Chinese hands, and then you know, the South China Sea and you know, the part of the Pacific. I think it's going to be very difficult for the U.S. to honor security alliances with Korea and Japan and Philippines, so to speak. And so I think there's important reasons why it wouldn't be that easy. And also, China has a huge incentive to preserve the status quo because, you know, you're 30% of global manufacturing. Your lifeline, your economic lifeline depends on it. And it's not such an easy decision, you know, to want to be cut off from the global trading system because of that. So I think there's a lot of things that have to be considered. Now, what I would say is that the red line for China is it doesn't want Taiwan to declare independence, right? So far, all the military buildup, the exercises encircling Taiwan is aimed at, you know, preventing Taiwan from, you know, declaring independence, or the U.S. supporting Taiwan to become independent. So as long as that red line is not crossed, I think the status quo can be preserved.
Okay. Louis, thank you. Hey, we got a question earlier from Jewellen about which asset classes would be most attractive for investment in China. And based on what y'all have shared, I could form my own opinions, but I'll keep my answers to myself for now. And anybody want to tackle that one? Which asset classes are most attractive in China?
Yeah, I would say if you look at Chinese equities, they're trading at a 20% or greater than 20% discount to the rest of MSCI emerging markets, right? And if you look at past history, you know, 20% discount is actually the widest discount it's ever been. So the last time was 2016 when, you know, the SOEs were suffering under a lot of debt, and there was a lot of concern over. So what I'm saying is that Chinese equities are already trading at a rock bottom valuation. You know, any slight improvement in the economy or improvement in geopolitical sentiment, you know, could drive that, you know, a surprise rally, right? So that's one. I think the second thing is that this is domestic investor sentiment in China. A lot of them are scared of what's happening. So many of them are actually investing in gold. And, you know, in recessionary environments, gold and commodities, you know, and physical assets tend to be a pretty good hedged, you know, downside hedge. So some of those things, you know, I would mention. I think the fixed income market is complicated because the yield on Chinese government bonds is only 2 to 3%. And in an economic recovery, if China were to experience any kind of inflation, those bonds would immediately be at risk, right? Those that you buy at low yields thinking that you're safe. So that would just be my overarching comment on asset classes in China.
Thank you, Louis. Victor?
Generally agree. I mean, you know, of course, I also I would buy some U.S. Treasury given the yields these days. But basically, I think Chinese equity, I agree with Louis. Potentially, there are some upsides. But I would isolate that from the bank stocks, which is, you know, as you know, is a big proportion, you know, pretty sizable proportion of like these H-share or A-share indexes. The banks, you know, to the extent that there are a lot of problems in the property sector, financial sector, the banks will have to eat the costs of that to a large extent. So that's not really, I mean, plus also, as you know, with low rates in China leads to margin compression for the banks. So you have like low rates, margin compression. On top of that, a lot of potential NPL issues coming down the pipeline. Banks will have to write down, various risks. So if there's a way to isolate your exposure to Chinese equity, isolate it from the banking sector, I think that would be more ideal.
I have to thank Victor for, running an ad on active management in China.
Hey, I've got one more question, and then the last question I'm going to ask for each of you is, what do you want to talk about that we didn't ask? And the question I'll ask before we get to that one is, we've talked largely from a U.S. perspective with today's conversation. Does the tone, the content of your comments change at all if you're in Australia, let's say? Because we had a couple of people register from Australia or anywhere else in Southeast Asia.
Yeah, I think if you go back to kind of that geopolitical alignment map that I showed in one of my slides, the sentiment is actually very different if you go to some of those non-aligned places, right? So if you go to Latin America, Southeast Asia, Africa, and then if you go to some of those commodity exporting countries like Saudi Arabia, UAE, and even in parts of Europe, the sentiment towards China is a lot less bad than the sentiment in the US, right? And so, one of the things that I follow is kind of the sovereign wealth assets and where they're invested, right? So if you look at the Middle Eastern sovereign wealth investors, as well as, for example, the Singapore or Canadian sovereign wealth funds, I mean, they hold sizable Chinese assets, right? And they might, reshuffle some of their composition, but, it runs in the hundreds of billions. So the fact that, they haven't divested all of it, and, the relationship between some of these countries with China is still fairly amicable. And China has a huge presence in Southeast Asia, for example. And so I don't think these places will completely decouple. And so if you talk to some of those people in some of those places, you get a very different feeling.
Okay, thank you. Victor, anything to add there?
No. I mean, I would completely agree. Although I think, I think a lot of people in other parts of the world, it's more of this feeling of resentment against the US as opposed to genuine sort of favor or liking China. So a lot of these China Belt and Road initiatives have benefited the elites of a lot of these countries primarily. Whereas for the US, I think we spent a lot of diplomatic effort to get to know people on the ground, society supporting NGOs and all that kind of stuff. The problem is a lot of US programs don't translate into a lot of dollar amounts, so it doesn't make the headlines, but there's a lot more of those kinds of initiatives. But yeah, I agree that it's certainly the polarization is not nearly as clear outside of the US and Western Europe, and we have to bear that in mind.
Okay, thank you. And hey, as promised, last question, because I know we're a little over top of the hour. Maybe start with Victor. Any closing thoughts? Anything you want to hit that we didn't hit?
No, I mean, I think investing in China is challenging. I mean, the other thing is, of course, there's been round and rounds of crackdown on sort of social media and the cultural sphere in China. I don't think it needs to be a one-way street. Of course, we do know Xi Jinping has this kind of preference for pretty strict control. But the other dynamic is that things are getting pretty challenging in the economy. We do see him delegating some decision making to other officials over time. And so potentially you could have a little bit of relaxation in the cultural sphere, which then hopefully will help some of these social media platforms, online gaming, et cetera, those kinds of themes. I don't see it as imminent, but over a kind of a 2-3 year horizon, we could see a bit of relaxation.
Okay.
Yeah, I would support Victor's point. The other thing that we didn't talk about is the effect on AI, right? And so kind of tying it back to what Victor said, some of the companies that are involved in AI development, either to help their own operations or to actually sell AI services to their cloud customers, are some of the biggest internet companies in China, the biggest live streaming and social media companies in China. So if China really wants to implement and develop AI, then they can't kill all the tech companies, because the private sector is the one that has invested a lot in AI. So if you look at how much investment has gone into AI, China is actually second to the US in terms of the amount of private investment going to AI. But the risk is, if China over controls AI, then there could be a problem in terms of implementation, diffusion of AI, and actually monetizing AI, right? So I think that's one thing that China has to be careful of, over-regulation as well.
Yeah, wow. That if we host another panel on this, that might be the launching point for a whole nother hour-long discussion. But given that we're already over, we're going to wrap things up there. And before we officially close things out, just want to thank again everybody who joined us today, and also thank you very, very much to our panelists, Dr. Victor Shih and Louis Lau. If you're interested, just a little bit about the Brandis Center. We've got an email list. I'm going to test my multitasking skills here. I want to try to put my email in the chat. If you're interested in signing up, I promise we won't inundate you, but we'll keep you posted on future discussions and share any research reports that we've got coming out. So again, if you're interested, just hit me with an email, rpschmidt@ucsd.edu. So coming back to today, once again, thank you to everybody who's joined us. And on behalf of the Brandis Center, the Rady School, the School of Global Policy and Strategy, Brandis Investment Partners, UC San Diego, thanks again, everybody. We hope to see you at a future event. This concludes our event for today. Thanks again.
Thank you, Bob. Thank you, Victor.